All right, let's talk about Donegal Group because what happened with their latest earnings report is a real head scratcher. On the surface, it looked like a solid win, but the stock, well, the stock told a completely different story. So, what exactly is going on here?
So check this out. Donegal comes out and beats Wall Street's profit estimates by a healthy 10%. Normally, you'd expect a nice little pop in the stock price, right? But instead, bam, the stock gets hammered, dropping over 6%. This is the paradox we're going to unpack. So what gives? Why the huge disconnect? Clearly, Wall Street was looking past that headline earnings number and saw something else in the report that it did not like one bit.
And here's our first big clue. You see, while the profit number was great, the top line, not so much. Revenue actually missed expectations. But the real red flag for an insurance company is that number right at the bottom, net premiums written. That's their pipeline for future business, and it actually shrank by more than 5%. Yeah, that's what spooked investors. But here's the twist. This top-line weakness wasn't some accident or a sign that the business was falling apart. Nope. It was completely intentional, a very deliberate move by management. So where did that decline come from? It was all in their personal lines business. Car insurance, homeowners insurance. They took a chainsaw to it, with premiums written plunging over 15%. They were actively cutting unprofitable policies and even walked away from an entire block of business in Maryland because it just wasn't making them money.
On the flip side, in their more profitable commercial lines segment, they actually saw some modest growth. They're being picky here, disciplined, only writing business that makes sense instead of just chasing growth for growth's sake.
And that right there, that's the whole strategy in a nutshell. They're making a trade-off. They're willing to be a smaller company in the short term if it means they can be a much more profitable one. The market sold off on the smaller part, but management is laser-focused on the more profitable part. And do you want proof that this strategy is working? It all comes down to this one number, 97.7%. That's their combined ratio. And let me tell you, that is a massive improvement from where they were last year. Okay, for anyone not deep in insurance land, a combined ratio under 100% is basically the holy grail. It means for every dollar you bring in from premiums, you're spending less than $1 on claims and expenses. You're actually making money from your core business of writing insurance. And that is exactly what this whole pruning strategy was designed to achieve.
Now, of course, this wasn't all just about their internal strategy. They're not operating in a vacuum. There were some other powerful forces at play this quarter, some helping, some hurting. It was really a tale of two opposing forces. On the headwind side, you had more storm damage than usual, which cost them, and they're still paying for a huge systems upgrade project. But fighting against that, they had some pretty strong tailwinds. Their investment income shot up thanks to higher interest rates, and they got a nice little boost because some of their old claims ended up costing less than they had originally set aside.
Let's dig into that systems upgrade I just mentioned for a second. Because for a while now, it's been a drag on their expenses, but it's just about to flip and become a huge long-term benefit. So they just hit a huge milestone. The last major piece for their commercial business is now in place. The final part for personal lines is coming later this year, and after that, the heavy spending is basically over. That cost, which has been weighing on results, is going to start fading away. It's like a built-in profit booster that's about to kick in over the next couple of years. And listen to what the CEO, Kevin Burke, is saying here. This isn't just about cutting costs. The real prize is that these new systems are going to make them smarter and more efficient at their core job of underwriting risk. That's the long-term game they're playing. Okay, so let's put all the pieces together. We've got a company that's shrinking on purpose to get more profitable. We've got clear evidence that the strategy is working. And we have a major expense that's about to turn into a tailwind. So, what does it all mean for the stock? Here's our take. We're initiating our coverage with a market perform reading. And here's why. You've got two competing stories. The company has done a fantastic job cleaning house and improving the bottom line. That's the bull case. But the market has very real concerns about when, or even if, they can get the top line growing again. That's the bear case. We're staying in the middle until one of those narratives clearly wins out. So, if you're leaning bullish on this stock, here's what you need to watch for. First, you need to see clear proof that those modernization costs are actually rolling off like they're supposed to. Second, a bit of good luck with a quiet storm season would be a huge help. And third, this is the big one, you need to see signs that they're ready to pivot that personal lines business back to profitable growth. On the other hand, the risks are pretty clear too. Another quarter of really severe weather could wipe out all their hard-earned gains. A change in pricing trends or a spike in inflation could squeeze their margins. But honestly, the biggest risk is that they just can't restart that growth engine. If they fail to prove they can be both profitable and growing, then the market's negative reaction might have been the right call after all.
This is not financial advice.